Hey, hello everyone. Good afternoon once again. So we Alpha from Simple Market Effects. So welcome to our fourth session concerning the training our way to the successful journey of this Forex industry. So okay, now let's continue it. So today we want to know when to buy or when to sell the currency pair. As we have learned from the previous videos that on Forex industry we deal with currency pair. That is our first product that we use to sell and buy. So when you buy, you make profit. When you sell, you make profit. The bigger problem in this Forex industry is that to understand where to buy and when to sell. So for this session, I think I'm going to cover some few topics so that you can understand well when to buy and when to sell a currency pair. Forex trading involves trying to predict which currency will rise or fall versus another currency. How do you know when to buy or sell a currency pair? Example, we're going to use a little fundamental analysis to help us decide whether to buy or sell a specific currency pair. Let's take an example of Euro USD is the base currency and thus the basis for the buy or sell. If you believe that the US economy will continue to weaken, I mean the US dollar economy, if it will weaken, that means the weakening of the economy is bad for the US dollar. You will execute a buy Euro USD dollar. That means, you will execute a Euro USD buy order. That means the Euro is having strength while USD is losing strength. So when you buy Euro while USD is lower, you will make money because the price will rise. That's the main purpose of this. By doing so, you have bought Euro with the expectation that it will rise versus the US dollar. If you believe the US dollar economy is strong and the Euro will weaken against the US dollar, you will execute a sell. So the vice versa is true for this case. By doing so, you have sold Euro with expectation that it will fall versus the US dollar. USD JPY is another example for today. In this example, the US dollar is the base currency and thus the basis for the buy or sell. If you think that the JPY government is going to weaken, then the yen, in order to help its export industry, you will execute a buy USD JPY order. By doing so, you have bought a USD with expectations that it will rise with the Japanese yen. This is the vice versa to the previous example. If you believe that the Japanese investors are pulling money out of the US financial market and converting all their dollar back to yen, and this will hurt the US dollar, you would execute a sell USD JPY order. So here we see when to buy and when to sell. You sell when the currency is when the quote currency is losing strength. You buy when the quote currency you buy when the quote currency is losing strength, and you sell when the quote currency is gaining strength. Similar to what we have explained here. Trading in lots. When you go to the grocery store and want to buy an egg, you cannot just buy a single egg. They came in dozen or lots of 12. This means that you're not going to buy only one pair of shoes, only a single shoe. You have to buy a pair of shoes. That's the meaning of this. In Forex, it will be just as foolish to buy €1, so they usually come in a lot, or 1,000 units of currency, which is micro lot, 10,000 units of mini lot, and 100,000 units of standard lot, depending on your broker and the type of the account. This continues so that you can understand it in depth. We have margin trading, but I don't have enough money to buy 10,000 euro. Can I still trade? The same refer to trading lots. We don't buy only a single euro. We buy them in a quantity, in a huge quantity, and this quantity are placed in a unit. We have 1,000 unit, 10,000 unit, and 100,000 units. So you can buy by using leverage. So those units, we use leverage to buy those huge units because we cannot afford to buy those. That's a lot of quantity of euro. So when you trade with leverage, you do not need to pay the 10,000 than euros upfront. Instead, you'll put down a small deposit known as margin, which is your capital. Leverage is the ratio of the transaction size or position size to the actual cash trading capital used for margin. For example, you have a leverage of 1:50, also known as a 2% margin requirement, means 2,000 USD of margin is required to open a position size worth $100,000. Margin lets you open a position size using only a fraction of capital you normally need. This is how you'll be able to open a 250 USD or 50,000 USD position size with a little as 5 USD or 1,000 USD. You can conduct relatively large transactions with a small amount of initial capital, literally carefully, because this is very important. We believe that the signal in the market are indicating the British pound will go up. So in order to place a trade, you need to understand very, very carefully where the direction of the market is heading. So we have a lot of explanation here. I will send the PDF to the Telegram channel, so you'll have your time to refer it. So this is what happened in the market. For example, you buy 100,000 pounds at the exchange rate of 1.5 USD, and the pound, you bought 100,000 pound unit, and you sell one, and you minus 150,000 USD unit. You take a power nap for 20 minutes, and then the pound USD exchange rate rises up to 1.5050, and you sell. Remember that you buy, and then the quantity rise within a 20 minutes up to 1.5050. So here you will have a negative 100 unity of pound, and you will have a rise of 150,000, 500 increase of US dollar. So you have earned a profit of 500 USD, in which you will have a 0 pound, and you will have a profit of 500 pound USD. I mean 500 plus USD. When you decide to close the position, the deposit margin that you originally made is returned to you, and calculation of your profit or losses is done. This profit or loss is then credited to your account. So after you place a trade, they automatically converted into USD, and then your profit will be deposited on your initial account. That's the meaning of this. So let's review the pound USD trade example above. I mean this one. The pound went up a mere half a pence, not even 1 pence. It was half a pence, but you made 500 USD. Try to gain a power nap. How? Because you are not trading just €1. If your position was €1, was 1 pound, yes, you would have made only half a pence, but your position size was 100 pound unit or 150 USD when you open the trade. Remember that you open this trade at 1.50, which means it's equal to 100 units. I mean 100,000 US dollar unit. But your position size was 100,000 pounds, or what it needs is that you didn't have to put that entire amount. All that was required to open a trade was 3,000 USD in margin, and you make a profit of $500 USD from $3,000 in capital, in which this is an increase or return of 6.67%. In 20 minutes, you manage to make $500 profit. That is the power of leverage trading. Small margin deposits can lead to large losses as well. This is the vice versa. When you use leverage and it went on your direction, you make money. The same when it went in on your opposite direction, you lose money. So the vice versa is true. You need to know how you can use this leverage on your side. So we have another term known as rollover. What is rollover in forex trading? Rollover for a position at your broker, for positions open at your brokers. Cutoff time usually at 5 o'clock p.m. ET. There is a daily rollover fee. This is the fee in which your broker cut it for his payment, also known as a swap fee, that a trader either pays or earns depending on the position you have open. If you do not want to earn or pay interest on a position, simply make sure they are all closed before 5 o'clock p.m. ET. Establish the end of the market day. Since every currency trade involves borrowing one currency to buy another, interest rollover charges are part of the forex. Interest is paid on the currency that is borrowed. Interest is earned on the one that is bought. If you are buying currency with high interest rate than the one you are borrowing, then the net interest rate will be positive. In example, USD/JPY, and you will earn interest rates as a result. Conversely, if the interest rate differential is negative, then you will have to pay. So if the interest rate between two currencies of the pair you trade, if the result is positive when you take one interest minus another, then the result is positive. You will gain the profit from that interest. If it's negative, you'll lose that amount. So for today, we are going to end it here on Rollove. Nothing much more will be explained on the coming session. Don't forget to subscribe and like and turn notification on, because I'm going to post a very hot topic. This one we just covered shallow, and I will send the PDF to the Telegram channel. Don't forget to join the channel so that you can get more updates concerning this upload of this training. Thank you so much. Have a nice day.